In this video, I'm going to tell you the truth about mortgage interest and show you how to pay off your home loan early in Australia. With these strategies, you can save a ton of money by reducing the amount of interest you'll pay and finish paying off your home loan years ahead of schedule. Let's get straight into it. How interest affects the mortgage. A mortgage or a home loan is a loan from a bank or lender that helps you buy a home. In Australia, when you sign up for a home loan, you will be given a monthly repayment schedule depending on how long your loan term is. Now, many Australians focus only on whether they can afford the monthly payments, but it's important to understand how much of those payments actually go towards interest over the lifetime of the loan. Banks are not typically transparent about this, so it's in your best interest to understand this key factor. By doing so, you can save tens or hundreds of thousands of dollars on interest payments and even cut years of your home loan. Your monthly repayments consist of two main parts, principal and interest. The principal is the original amount of money you borrow from the bank or lender to buy your home. Interest is a fee the bank charges you for borrowing their money. Interest rates are influenced by several factors, including the Australian economy, your personal financial situation, and the RBA, which sets the official cash rate nearly every month, a rate that banks typically follow. The higher the interest rate, the higher your monthly payments will be, and the more interest you'll pay over the life of your home loan. Therefore, understanding how much of your monthly repayments go toward principal versus interest is very important. This is particularly important in Australia's current environment of relatively high interest rates, where many Australians are struggling to meet their monthly repayments. Another key factor to understand is the amortization schedule. This shows how your home loan will be repaid over time and exactly how long it will take to pay it off. In Australia, most home loans have terms of 25 or 30 years, with 30 years being the most common. While a longer loan term means lower monthly repayments, making it appear more affordable to the average Aussie, you will end up paying a higher amount of total interest over the life of the loan. How much interest you actually pay. I'll now go through an example to show you how much interest you actually pay over the life of a home loan. Let's say you took out a $600,000 home loan with a 30-year term at a simple 5% interest rate. Assuming the interest rate remains the same over the life of the loan and you make no extra repayments, you'll pay a total of $1.16 million. Of this amount, $600K goes toward the principal, while a whopping $559K goes towards interest. This means you're paying nearly the same amount in interest as you borrowed in the first place. Shocking stuff, right? You could have bought two houses. And it gets crazier as the interest rate increases. At 6% interest, you'd pay $695K in total interest, more than your original loan amount. At 7%, $837K. At 8%, $984K. Crazy stuff, but hopefully we don't get to these levels anytime soon in Australia. If interest rates increase, your monthly repayments will also increase as a result. If you're currently researching how much you can afford to borrow, be sure to consider some worst case scenarios like increasing interest rates. Just because you can afford to repay a certain monthly amount does not mean you should just go for that amount. You might be able to afford payments at a 5% interest rate, but what if rates suddenly jump up to 7 or 8%? Just something to think about and prepare for accordingly. How to calculate the mortgage interest. I'll now show you how to easily calculate mortgage interest using an online calculator that lets you experiment with different numbers and rates. I'll leave a link to this calculator in the description below so you can play at home too. Let's enter the numbers from our previous example. 600K loan, 30-year term, 5% interest rate, and we'll leave the remaining term at 30 years. After we enter these figures, the calculator shows the monthly payment is $3,221. The total you'll pay over the life of the loan is $1.16 million, with $559K of that being interest alone. If you click View Amortization Table, you'll see your complete payment schedule for the next 30 years or 360 months. Assuming interest rates remain the same and you make no extra repayments, this will be your exact repayment plan. Also notice how at the beginning of your loan, most of your monthly payments go towards interest rather than principal. It's only around the halfway point of the loan term that you start paying more toward the principal than interest. It is structured this way to ensure the bank earns more of its interest income early in the loan before the loan balance declines too much. But the good news is there are several strategies to combat this, which will help you save on interest and cut years off your home loan. Let's go through them now. The first strategy is to make extra repayments. This is extra money on top of the payment you must make every month. It sounds simple, but the impact is massive. Every extra dollar you throw at your home loan goes straight to reducing the principal, which means you pay less interest over time. It's like a snowball. Once it starts rolling, it gets faster and faster. Let's go back to our calculator and change the repayment options from normal repayment to repayment with extra payments. Let's see what happens if we make an extra $100 payment per month. After clicking calculate, we get a nice little summary at the top. By paying an extra $100 monthly, you reduce your home loan by almost 2 years and save around $43K in interest. Not too shabby, but I think we can do better. How about $500 extra per month? With this amount, you shave off 7 years and 7 months from your loan and save $162K in interest. That's a huge saving. Looking at the monthly amortization schedule, you'll start paying more of the principal for month 1, and by year 8, you're paying more towards your principal than interest. And of course, the more extra payments you can make, the more interest you'll save and the quicker you'll pay off your home loan. The next strategy is to make a lump sum payment. If you suddenly come across a chunk of money like a tax refund, a work bonus, an inheritance, or even money from selling something you no longer need, you can throw that directly into your home loan. I know when you receive unexpected money, it's very tempting to spend it on a new iPhone or a trip to Bali, but using it to reduce your home loan will buy you something even better. Long-term financial freedom by owning your home sooner. So let's say you receive a tax refund of $5,000 and decide to make a lump sum payment into your home loan. Let's enter $5,000 in the one-time tab and click calculate. You've now shaved off 6 months from your loan and saved around $17,000 in interest over the life of the loan. If you make a $10,000 lump sum payment, you'll shave over a year off your loan and save $33,000 in interest. Combining occasional lump sum payments with extra monthly repayments will significantly accelerate your journey to paying off your loan. The next strategy is to change from monthly payments to fortnightly payments. This might seem subtle, but it makes a significant difference in the long run. There are 26 fortnights in a year, but only 12 months, so you'll essentially make the equivalent of one extra month's repayment every year without really noticing it. Let's change the calculator to bi-weekly repayment and hit calculate. So by switching to fortnightly payments, you shave off 4 years and 8 months from your loan and save $100,000 in interest. I believe this is probably the best bang for your buck strategy that most Aussies could implement right now. These days, you could log into your bank and change it within a few minutes. You likely won't even notice making those extra few payments per year, but the difference in savings is quite significant, especially if you combine it with the previous two strategies. The next strategy is to refinance your loan strategically. This is a powerful approach that banks prefer you don't know about. In today's Australian market, competition among lenders is hotter than ever. Along with the big banks, smaller banks and online lenders are all competing for your business. This gives you significant bargaining power. Remember how I showed you earlier that even a small increase in interest rate can dramatically impact your total payment? Well, this also works the other way. You can save a lot by reducing your interest. Refinancing with a bank that offers just 0.5% lower interest rate can save you tens of thousands of dollars over the life of your loan. For example, on a $600,000 loan at 6%, you'll pay approximately $3,600 a month. Refinancing to 5.5% reduces your monthly payment by nearly $200. That's $2,400 annually and more than $70,000 in interest over 30 years. And that's just with a 0.5% reduction. Imagine the savings with 1% or more. Here's a common mistake many Australians make. They remain with the same banks for decades out of habit and laziness. But loyalty does not pay when it comes to home loans. The smarter approach is to review your home loan every 12 to 24 months. When interest rates drop, consider refinancing. This does not necessarily mean changing banks. You can contact your current bank and request a rate review. Banks rarely offer their best rates automatically to their current customers. So calling or requesting a review online could get your rate lowered to match what they offer new customers. If a new lender is offering cashback deals or lower rates, you can take advantage. Just make sure to research thoroughly to confirm they're reputable. Don't just sign up with any random lenders you see online just because they're cheap. And if your current bank refuses to improve your deal, don't hesitate to switch. Staying put means paying what I call the lazy tax, potentially costing you thousands of dollars more over the life of your loan. While refinancing involves some paperwork, it's typically much easier than you think, especially if you organize all the relevant information in one place. And the upside? You can save thousands of dollars every year and pay off your home loan quicker. Another indirect strategy is to invest any extra money into the stock market rather than making extra home loan repayments. Now, this is one of the biggest debates in the personal finance world. The reasoning for investing your money instead is straightforward. Stocks generally offer higher potential returns, so you might get better long-term results by investing instead of paying extra into your home loan. Over the long run, the Australian and US stock markets have historically returned around 7 to 10% on average per year. In the last 30 years, returns have averaged approximately 9 to 11% annually. That's higher than the average home loan rates in Australia during the same period. There are pros and cons to both approaches, but I won't get into them in this video. I simply wanted to mention this as an alternative option. If you'd like to learn more about investing versus making extra home loan payments, I have made a separate video on this topic which I'll link in the description below. At the end of the day, paying off your home loan early comes down to a few simple principles. Understand how interest rates really work, make smart use of strategies like extra repayments and fortnightly payments, and not being afraid to shop around for a better deal. Whether you apply one or all of these strategies, each step brings you closer to owning your home outright and achieving financial freedom. The earlier you start, the greater the impact and the less money the banks make from you. Remember, your home loan doesn't have to be a 30-year sentence. With the right approach and a bit of discipline, you can shave years of your loan, save hundreds of thousands in interest, and give yourself the ultimate reward. A home that's 100% yours. Quick disclaimer, this video is for educational purposes only and should not be considered financial advice. Please remember that investing involves risk and past performances does not guarantee future results. Please do your own research before making any investing decisions. And if you'd like financial advice, please go speak to a professional. By the way, if you're enjoying this video and made it this far, comment the words "my house, my rules" down below so I know who you are. And if you're new around here, what are you waiting for, mate? Hit that subscribe button and join this amazing community of like-minded people. Also, please consider signing up for my free newsletter, Aussie Money Club, where once a week I'll send you some money tips, major news in the market, or any cool live updates from me. And if you want to learn more about investing versus paying extra into your mortgage, check out this video on screen where I discuss the pros and cons of each option and which one will best suit you. And as always, thank you for watching, I appreciate you, and I'll see you in the next video.